Welcome back. The Reserve Bank released data which has caused a bit of a stir. Household savings, net savings as a percentage of GDP is at a 47-year low of 5.1%. Even gross savings are lower at 10.9, but that's more like perhaps a 6-year or a 10-year low. And household liabilities have gone up, and that's about a 2-decade high. So are we in a kind of a problem, micro problem of too much indebtedness, and a macro problem of will we be able to finance our growth aspirations? I've been speaking with Nikhil Gupta of Motilal Oswal, Abhishek Upadhyay of ISEC Primary Dealership Unit, and Ratin Roy of Overseas Development Institute. Gentlemen, thank you for your patience. Nikhil, before going to break, Ratin raised the issue that if households are saving less, much less than they did a few years ago, and government is just saving, corporate sector not really investing much, are we in a low growth trap? I mean, who will finance the growth? Do you think that this is a big macro question?
Yes, Lata, that has been at the core of the entire situation or the analysis that we have done in the past few years. What we need to understand is that at this point in time, there is no risk as Dr. Roy mentioned, there is no risk as to the funding of the government fiscal deficit, primarily because the corporate sector is not investing. And that is why the more profits that we have, the more surplus the corporate sector is having, which is in turn funding the fiscal deficit, despite the fact that household financial savings have gone down. If the corporate sector decides tomorrow to invest, if that happens, then there are only two possible situations. One, either the government will have to reduce their fiscal deficit, which is not going to be an easy thing, or the current account deficit will widen. There is no other way. With lower household savings, we are able to fund government fiscal deficit at this point only because the corporate investment is weak at the same time when corporate profits or surplus is high. That is one. Secondly, I want to mention about this entire connection between household borrowings and household savings. See, one of the facts that I've been hearing is it is okay if the household net financial savings are lower, because it is not because gross financial savings have come off, it is because households have borrowed more. And households borrow to invest or to consume. So they are spending, which is a good thing. They are supporting GDP growth. There should not be a concern. Now, the concern is not in the immediate term. It is not in the short term. But please understand, if households continue to borrow and their debt continues to rise, then as we progress into the years, households will be spending a larger and larger share of their income to service those debts, which means that I will have a smaller portion of income, which is truly disposable income, by which I mean the proportion of income available to consume and save will continue to fall as the ratio of debt servicing keeps going up with rising debt to income ratio. Now, logically speaking, we are an aspirational economy, we are a young economy, so my consumption growth is something considered structural, that my consumption growth will remain at 7%. If that is the case, then we are saying there is a structural case that savings will remain low. And if that is the case, then we fall into that trap, that is household savings continue to remain low. What will fund government fiscal deficit if corporate sector decides tomorrow to invest?
Okay.
Because that is possible only and only through higher CAD, which is very recent in our memories. What higher CAD can do, we have seen during FY 10 to 13. So I don't think any one of us want to see a repeat of that.
No, we don't want that. One only hopes that private sector finds the reason to invest if households are showing the proclivity to consume that they are. Abhishek, your macro observations, you spoke about the current account deficit already likely to rise if we continue with low savings and high government borrowing. But just a broader question, I haven't been able to put this data on air, but our savings rate in 2000, 2001 was as low as 25%, 26%. And then we rise all the way to 36%, 38% in the 2008-2012 period. And now it is back at 30%. So overall savings also is indicating that we will not be able to finance higher growth, is it? Is that what we should take away from this savings peaking off rather decisively?
Well, there are various issues there. One is, when you're looking at household savings, there are two parts. Net financial assets, as we have been discussing, and the other is the physical savings, investment in real estate, etc. So what we had in the last decade is, real estate cycle was down, and therefore household physical savings also went down. And that was also a factor which was weighing down on overall gross savings. What we have seen of late, and one reason why net financial assets number was so low and liability number was so high was because a lot of mortgage loans, etc., are taking place now as real estate cycle, trends higher again. So that is one mitigating factor that maybe we are still in the early stages of this, and there is still nothing to suggest that we have a real estate bubble which can create financial stability issue, right? But the broader issue really is, and which was discussed, whether government can bring down fiscal deficit quickly as private capex recovery starts to happen, and that is going to be the critical issue that we need to discuss more. Only reprieve here is that if you're looking at government fiscal deficit, if you're compared to pre-COVID years, there has been a substantial increase in infrastructure investment and capex part of spending, which is a relief. But overall, fiscal deficit still needs to come down reasonably quickly as capex starts to happen.
Okay. Ratin, actually running at the last 1 minute of the discussion, what would your final observations be? Do you think that government's fiscal transfers, at least during the COVID years, were to prop up consumption in a helpless situation? And to be fair, the central government capex itself has been healthy. While fiscal deficit is high, it is kind of geared towards growth from its capex element. So things are not as bleak if the government is holding the capex baby till the corporate sector takes it from them.
Well, 2 quick points. One, Nikhil Gupta has shown quite nicely that actually that's not true. The increase in on-budget capex has been almost entirely matched by a decrease in public sector capex. So that basically what you're seeing there is a reshuffling of capex within the public sector balance sheet. Second, capex in India, very famously, depends on when it is complete. You're all from Bombay. Where is this Bombay airport? I've been hearing about it since I was 15 years old. So, given the time delays and cost overruns in capex, the impact of capex on growth actually comes when you actually complete and finish a capex project, and that's not happening. Third, the import content of a lot of the capex we do in the road sector, in the transport sector is very, very high. Those 190 planes they're going to buy from the USA, which Biden is very happy about, that's capex, but that's all imported. So the economic impact of that is minor. The second point I want to make is related, which is this points to one more thing. This suit boot Indian growth story is over. You're talking about mortgages. Who takes mortgages in India? A very small segment of the population. So what is happening now is that to a large extent, the macro numbers that the Indian economy reflects continue to be based on the consumption and investment behavior of a very small part of the population. We have not been able to broad base it. Even people taking 3 to 4x the minimum wage don't go to the market, take EMIs and build houses in tier 2, tier 3 cities. People talk about it, but it isn't happening in any significant measure. So until we're able to broad base our growth process, I think what this shows us is what is classically called a low-level equilibrium trap, which is to basically be in a situation where there is nothing more to invest on because there's no incremental market. The capital stock you have is enough to finance aggregate consumption now. There's some cross-switching of consumption between sectors. You chug along at 5 to 6%, but your growth story is over because you could not broad base it. I think this is yet another signal. This is
I remember the piece you wrote about this about 5-6 years ago on how even the 1991 broad basing of consumption was only broad basing it from probably 5% to 15%, but it is still a very narrow class that you can describe as the formal economy. This was an extremely rich discussion. some initial worries on how are we going to finance macro growth and broad basing of Indian consumption is clearly coming out from these numbers. But let's not run away that there is a problem of unsecured debt or NPAs. Perhaps this divergence between growing liabilities and falling savings will get corrected. Let's hope it's only a result of the COVID period. This discussion will be on. Thank you very much for kick-starting this discussion on a high note. Nikhil Gupta, Abhishek and Ratin Roy, thank you very much for joining me.